Good afternoon and welcome to today's wealthmanagement.com webinar, Increased Longevity Changes, Outlook for Life Insurance. I'm Rich Santos, Group Publisher of wealthmanagement.com, the digital resource of Rep and Trust and Estates. In a moment, I'll be turning things over to our presenter, but first I'd like to thank our sponsor, the LifeLine, for making this afternoon's webinar possible. The LifeLine program is one of the oldest and most established life insurance settlement providers in the nation. They serve the financial needs of the elderly and terminally ill while offering a stable and profitable investment environment for the company's agents, investors, and supporters. In a typical transaction, an existing life insurance policy is sold by an elderly policyholder for more than the current cash surrender value. A settlement is a unique alternative to surrendering a policy or allowing it to lapse, and in many instances, a settlement enables an elderly individual live out the remainder of their life with dignity. The LifeLine program actively partners with insurance agencies and brokers-dealers to establish profitable and ongoing life settlement business lines. I'd like to remind the audience, if you have any technical difficulties during today's session, simply press the Help button on your player console to receive assistance in solving common issues. And if at any time you're having audio difficulties or the advancing of slides, simply hit your F5 key to refresh your webinar console. Also, during today's webinar, we welcome your questions about the topic. To submit a question, simply type it into the question window on the lower left-hand side of your console and hit the Submit button. We'll be answering as many of these questions as possible during the Q&A portion of this webinar, but please feel free to send in your questions at any time, and we'll add them to the queue. Finally, please be aware that today's session is being recorded and will be available on demand for your on-demand viewing within the next week, and you'll be notified by email when this event archive is available. Now I'd like to introduce our first speaker. Scott Page. William Scott Page is the President and CEO of the LifeLine program. He is a pioneer of the life insurance settlement industry, which in the past 20 years has grown from a niche business into a mainstream financial services industry. Page is widely regarded for his efforts to conceive and lobby for legislation that protects both the insured and the investor. He's an acknowledged national spokesperson for the industry. He's testified before many government bodies regarding the creation of licensing requirements. He also assisted the government in its efforts to crack down on investor fraud. He frequently serves as an expert panelist. He's been on Stuart Varney's Fox Business Network television show. He's appeared on other national television programs such as 2020, NBC Nightly News, The Phil Donahue Show. He's featured in national publications like U.S. News and World Report, The Wall Street Journal, The New York Times, The Economist, and the list goes on. In 2011, he began publishing a guest blog for the Huffington Post. He's distinguished himself as not only an expert on life settlement, but also on issues facing seniors and boomers. He regularly contributes articles to and is quoted in industry publications such as National Underwriter, California Broker, Life and Health Advisor, and Insurance News Net. He began his career in the military, serving from 84 to 88 in the U.S. Air Force. He attended York College in Pennsylvania and the United States Air Force School of Aerospace Medicine in Texas. He currently lives in Atlanta and remains active in civic and community and national organizations. Joining Scott this afternoon is Scott Sanders, Director of Capital Markets for LifeLine Capital Management, LLC. Scott Sanders has worked with the LifeLine program since 2009. As an outside advisor, he managed a significant equity capital raise, enabling the company to purchase policies as a principal, deploying its own capital rather than as an agent on behalf of third-party investors. This transition provided reliable liquidity in the secondary market and volumes of settled policies for the tertiary market. Sanders leads the company relationship with institutional market investors. He also establishes new distribution partnerships with RIAs, wirehouses, multifamily offices, and enables them to confidently discuss and recommend life settlement as a potential transaction for clients as a component of a holistic, objective financial planning process. Sanders' prior experience focused on retail and institutional financial services, including work as a consultant with high net worth clients and entities at Bank of America and Merrill Lynch, and corporate and structured finance at Wells Fargo, IBM Credit, Enron, and in private equity. He received his bachelor's degree in economics at the University of Minnesota and earned his master's in business administration at Northwestern. So with that, I will turn it over to the first Scott. That would be Scott Page. Sir, with that, the floor is yours.
Thank you very much, Rich, for that outstanding introduction. And everyone, I want to thank you for your time today joining in to our webinar. Hopefully you'll leave it knowing a little more than you did before you tuned in. Scott Sanders and I, also known as the Scott and Scott Show, will do our best to keep you entertained. We promise not to tell any corny jokes or add any unnecessary commentary. But you're here today to learn a little bit more about life settlements and longevity and how life insurance and the life insurance industry is reacting and responding to this new and innovative concept known as a life settlement. I don't think it's a surprise to anyone that we're living longer. With that, I use the good news, bad news analogy. The good news is we're going to be on this earth for a little bit longer. The bad news is we need to figure out a way to pay for it. Through some innovation, there's been some products that have brought out the longevity market, such as reverse mortgages, annuities, and life settlements were really the last and we believe the most effective. Life settlements add an element to the financial planning mix that was never thought of before. Most folks consider life insurance as a liability, something that you continuously pay premiums to keep the policy in force. And through life settlements, we allow the life insurance policy to look at as actually an asset, giving you the ability to sell that policy for funds when you need them or no longer need the life insurance policy. When we look at how much we're living longer, we're really not living that far past age 100. There are not many people that live past age 100. According to the UCLA's latest study, there are currently only 60 people in the world that have lived to 110 years old. Actually, 58 of those are women, and bad news is only 2 of them are men. The oldest woman right now in the world is living in Japan. She's 115. And the oldest man right now actually lives in New York, who's 112. So again, good news is we're living longer. Bad news is how we're going to pay for it. The graph currently on your screen sort of displays how there are almost 53,000 Americans that are over the age of 100, and that's representing almost a large percentage increase since 1950. It also takes into account the population has grown as well. I think everyone on the line and on the webinar realizes that this country is in a retirement crisis. There's been almost 44% of baby boomers are not confident that they have enough money to live through retirement. And almost half believe that they can make it, but 11% are very, very, very concerned and not confident that they can make it. And there's been several movements and governmental groups commissioned to study this problem, and really they're not finding many solutions. I think everyone's aware that it's a problem, but not a lot of people, again, are coming up with solutions. One of the first that we've seen a really active movement was something that you'll probably hear of if you haven't heard of it already, which is a Medicaid law that's taken effect. Texas was the first state to enable this law. And what this does is it requires a mandatory disclosure to anyone that is enrolling in a Medicaid. You might think, well, we're financial planners, and most people with Medicaid don't use financial planners. However, the awareness that's going to come from this change of law, specifically in Texas, is going to bleed over into other aspects of the market. One of the interesting elements of this Medicaid law is that anyone applying before they can get Medicaid from the state has to exhaust all their assets and do what's known as a Medicaid spend down. A recent study found that 1 in 4 Medicaid eligible people actually have a life insurance policy. Texas is the first state to enable this law. However, there are bills currently pending in California, Florida, Kentucky, Louisiana, Maine, New Jersey, and New York. One of the advantages of this law is it allows an individual to remain on private pay until the settlement funds are exhausted. Once an individual applies for Medicaid, they find out about life settlements. If they sell their policy, if they're one of the 4 that are enrolling in Medicaid can sell their policy, the funds are deposited into an FDIC account and used for long-term care expenses, and it's directed by the individual. So you do not have to go to a Medicaid provider. You can go to any provider you choose. So it's going to actually enhance the quality of care for individuals. A portion of these settlement proceeds are also saved in this FDIC account to cover a death benefit. So we believe that this new law in Texas and what we're seeing moving across the country is going to create a great awareness for life settlements. That will also bleed over into the larger, wealthier individuals with life insurance policies. Long-term care is an issue in the country. Costs for long-term care policies have been raised as much as 40%. There are many carriers who have come out of the market and no longer offering long-term care products. But at some point, everyone's going to need long-term care. 69% of people over the age of 90 or older have a disability and require some form of long-term care. The long-term care costs in ways it can't be measured, and not just through monetary issues. It also creates a large burden on the caregivers and the caregiver's family. And it's estimated that 1 in 4 adults are unpaid caregivers to an adult. Almost 40% of caregivers have to quit their job or reduce their hours to care for someone over the age of 50. So living longer is an issue, and we need to figure out the best way to deal with it. One of the innovations that we're going to talk about today is the availability of life settlements. Again, life settlements is the sale of an existing life insurance policy. And lots of life insurance policies are out there and existing and really have no idea that a life settlement is even a possibility. So life insurance are bought for several reasons, whether it's for business protection, estate tax, liquidity issues, key man, wealth replacement tools, ILITs, the Irrevocable Life Insurance Trust, which we're going to get into a little bit later, and charitable remainder trusts. But there's also the normal reasons or the standard reasons individuals buy life insurance policies, whether it's family protection, to make sure that the college is paid for, or, of course, provide in an event for the loss of a breadwinner. I think one of the largest myths that are circulating right now about life insurance is that the estate planning or my estate planning policy is going to keep me out of risk. If I have a life insurance policy that I took several years ago in an estate planning scenario, it's going to keep me out of risk. However, one of the dirty little secrets that the insurance industry doesn't want anyone to know about is that almost 96% of estate planning policies lapse within 8 years, meaning there's no death benefit paid, and the winner in that bet is the life insurance industry. The Wharton School of Business just completed a study called the narrow framing of an individual's thought process when they buy a life insurance policy. It uncovered some facts that life insurance policies are sold, and I put the word some quotes around that word sold. They're sold by the agent that is being pushed by the life insurance carrier. It's not always in the best interest of the insured or the individual buying that policy. What they're being sold is something that is imposed on them that they're told they need from the life insurance company and their agents. And they're all underestimating what's known as shocks that happen in someone's lifespan. That shock could be a financial burden, a loss of a job, a lifestyle change, failing economy, etc. All of these shocks cause individuals to rethink their budget and what's going out the door for paying bills. And unfortunately, life insurance is one of those luxury items. And when everyone buys that life insurance policy and they're sitting across the table from their agent, the agent's convincing them to get all the bells and whistles and whole life, universal life, build up cash value. Until you miss that first target premium payment and that cash value starts eroding and cannibalizing the policy, you start to realize, maybe I should have thought this through a little better. And that's where it comes to the statistic of about the majority, 96% of these policies lapse around year 8. And that's what Wharton School of Business also backed up, where they saw lapse rates. A lot of individuals don't realize that a life policy can be used as an asset versus a liability. The insurance companies, they want you to believe that you have 3 options. One, you can take the cash value out. That is, if there's any cash value left in the policy after you've missed that first target premium. You take out the paid-up policy. If anything is there, if you've made that decision before the cash value is starting to cannibalize itself within the policy. Or let the cash value pay the premiums. Now, the life insurance industry and life settlement industry exist in a love-hate relationship. When the industry first started, as you were told at the beginning of the webinar, the life insurance industry didn't pay too much attention to us since we were a small niche industry. Then they started imposing regulation, making it very difficult for life settlements to take place, imposing specific disclosures, analysis of policies, informing insureds of aspects of the policy that the life insurance company and the agent should tell them. For example, if someone tries to apply for a life settlement and if there's an accelerated death benefit rider, we have to go through the channel of the insurance company and make sure that the carrier or the insurance company will not apply or will not accept the accelerated death benefit rider before we can transact as a life settlement. So life insurance carriers like us and they don't like us, depending on the day. At this point in time, they seem to like us because carriers are concerned with cash flow. Cash flow is premium payments. So carriers now are enjoying the fact, since sales are down, that a life settlement company buys the policy and continues to pay the premium. One of the successes of the life insurance or the life settlement industry is a new disclosure requirement that we have now imposed on carriers. There are 7 states now that have mandatory disclosures to insureds over the age of 65 that they should consider a life settlement in lieu of lapsing or canceling the policy. Once again, this is an awareness issue, and we believe it's going to gain momentum and eventually fall as a mandatory disclosure in all 50 states. We talked about the option the life insurance companies don't want you to know about, which is, of course, a life settlement. Life settlement industry has been around for several years. The LifeLine program did the very first documented transaction in 1989. Since then, the industry has grown and become accepted now as a financial planning tool that should be held in the arsenal along with all the other recommended financial planning options. On average, a life settlement pays almost 60% of all the premiums that the individual has paid in over the years, which is a fantastic way to recoup the investment they've made in a life insurance policy. Currently, 42 out of the 50 states regulate life settlements. That's covering almost 90% of the United States population. There are a few states that do not regulate. However, the LifeLine program follows stringent regulation that conforms in all 50 states, regardless if there's regulation or not. I'd like to also invite you, if you would like more resource information from the LifeLine program, we just completed our latest white paper for financial professionals. You can call and speak to one of our specialists at any time at 1-800-252-5282 to get more information and request a copy of our latest white paper. ILETS has become a center of influence for the life settlement industry over the past year. There's been a change in the way that ILET trustees are required to examine the contents of a trust. In most current circumstances, the trustee sends out crummy notices, pays the premium, and sets it aside for the next year. An informal poll we've done with many trustees have said they view the life insurance policy almost as a redheaded stepchild. They're not quite sure why it was bought. All they know is their job now is to figure out how to keep it in force and to maximize the investment in the life insurance policy. We are advising trustees that have ILITs to talk to the beneficiary and the insured to make sure that the circumstances are still the same as when they purchased the policy. Again, many trustees and the insured don't realize that there's an option to sell that insurance policy. However, there's been change in goals, and the trustees should discuss these with the beneficiaries and the insured. Whether there's a wealth transfer, a sale of a business, a change in health, an increase or decrease of the net worth, these are all issues that could affect and actually perform for a positive of the insured for the sale of their policy through a life settlement. Trustees are now required to know options for life settlements as part of their fiduciary responsibility. The trustees' obligations are significant, requiring sophisticated approaches to the investment that really take into account high-risk return ratio for that specific particular trusts. They should pay attention to premium payments, of course, providing crummy notices to the beneficiary, and the policy review. Some of the questions that a trustee should ask are, is this policy performing as it originally was illustrated? Is the policy sufficient for current needs? Is there more competitive policy available? Could I actually sell this policy and replace it for a better priced policy? The Uniform Prudent Investment Act permits the trustee to delegate investment and management functions through a careful selection of the wealth manager and advisor to actually carefully do a periodic review of the policy. The LifeLine program has tools and resources available to help you speak to your clients about the reasons why they bought the life insurance policy and to increase your role as a trustee and make sure you're meeting all of your fiduciary requirements. The changes in estate taxes over the few years have also left wealthy individuals wondering why they're still paying for this expensive life insurance policy. As you're aware, the fiscal cliff was looming last year, and the exclusion of the $5.2 million was scheduled to change. We had a large spike in inquiries from individuals because they felt they would be overinsured and wanted to know what their options were with life insurance policies. Most policies that were issued 8-10 years ago could be replaced with less expensive replacement coverage. Based on today's life insurance rates, 85% of existing trusts could obtain a 40% reduction in premium cost for the same amount of coverage if they were to investigate it and look at the options available for that life insurance policy. Life settlements are becoming a recognized, valuable financial planning tool by several reputable organizations. Through USA Today, Wall Street Journal, the Huffington Post, AARP is now a fan of life settlements. It's been talked about on Dateline, Fox Business, CNN, Business Week, and Money. And now financial planners such as yourself are aware of this option. And anything the LifeLine program can do to provide you with more resource information, please feel free to contact us. At this point, I'd like to introduce Mr. Sanders.
Yes, I'm going to be very, very quick here. The next two slides here are really intended primarily to communicate to the audience that's actually on this call, which is predominantly wealth advisors and wealth managers. And what we learned as we expanded our efforts to reach out to the community of which you're members, we learned that there were typically questions about how big a market this is. Is there really a market for it? Do people really buy these policies? And as you'll see on these two pages, there is a market. The market most people think that the market peaked 2007, 2008 when there was approximately $12 billion in face value that transacted from insured sellers to secondary market buyers. The market hasn't been quite as large since then, although we've seen a significant uptick, especially, as Scott said, as a larger number of wealth advisors, managers, and insurance sales folks have been more involved in the transaction. The market has begun to come back, but you'll see what we've described here is we typically see that there's a significant disconnect between the policies that are otherwise good for a sale and the number that are. And so really what we're intending to describe here is that there is an opportunity for the wealth management community to speak with their clients about a life settlement. If you look at page 18 real quickly, the description here is that we've got about $3.8 billion in invested capital in life settlements, which represents close to $40 billion in face of in-force life insurance policies. And again, interestingly, if you look at the last bullet point here, that there's approximately $150 billion that kind of independent market observers describe as otherwise relevant for settlement by the year 2019. And what we think is this represents obviously a significant opportunity for the wealth advisory community to talk with their clients about policies that might not any longer make sense for them to hold, whether they're in an ILET or some other form. Again, the opportunity here is significant. So with that, I'm going to hand it back to Scott Page and finish out the presentation.
Thank you, Scott. The LifeLine program completed its own study of baby boomers just to make sure that we were on track with making sure our voice and our message was being heard of our audience. We found that almost 55% of the baby boomers we polled are going to need to work past the age of 65. Almost 30% would consider selling their life insurance policy to help fund their retirement. Almost 80%, which we thought was a staggering number, felt their financial planner or insurance professional should be informing them about life settlements as an option. Now, the role that the life settlement provider plays in your support is serving as a resource expert to wealth managers, advisors, and financial professionals, helping you create awareness and provide education around the secondary market for insurance policies. We also want to partner with ILET servicers, ILET trustees, and help them understand the value of life settlements, that they can provide a much better service and a complete service and cover their fiduciary responsibilities to their clients. If it's good for a moment, I'd like to cover how this life settlement process works. Of course, the first step is awareness and education. Either the policyholder or the financial provider or financial service professional discusses life settlement as an option with their client. They contact the LifeLine program. The LifeLine program reviews all documentation regarding in the process. There's two tracks to our due diligence. The first is medical. We have to have a complete look at the medical history and medical records of the insured. We do underwriting, and we forecast a life expectancy. We also look at the policy information to make sure that the policy is free, there's no liens against it, make sure it hasn't been assigned. We look at the premium illustrations to see what it's going to cost. If we believe the policy is viable, we will then make an offer. Once the policyholder accepts the offer, completes our contract package, we file change of ownership with the insurance company. Once the insurance company acknowledges the LifeLine program as the new owner of the policy, the transaction closes within 72 hours and a payment is made. At that point, the insured never has to worry about paying a premium again. In most cases, they have returned almost 60% of all the premiums paid. They've reimbursed themselves for renting that coverage. And in all cases, a life settlement pays 8 to 10 times more than if the insured would have surrendered that policy directly with the insurance company. Now, people sell policies for many different reasons, whether it's a lifestyle change, whether they're overinsured, they've been divorced, perhaps a bankruptcy, the sale of a business. We're seeing a big spike with key man policies where individuals have worked for large firms for years, executives. They leave the firm. The firm no longer wants to keep the coverage. The employee doesn't want to take over the premium, so the policies are just left to lapse. We work very closely with our spokesperson, which is Betty White. If you've been to our website or looked at any information for the LifeLine program, you've probably seen her smiling face. Betty White's 91 years old, and at a point in her career, she can do whatever she wants, and she believes in the LifeLine program and life settlements. And one of Betty's quotes from an interview was, a life settlement might not be for everyone, but she believes everyone should at least have this option. So again, life settlements are new, but until education happens and awareness happens, your client needs to know the options with the life settlement, and so do you. Another spike in life settlement transactions have been what we're calling term to perm. This is taking advantage of a term policy prior to its expiration or prior to it canceling. As you may be aware, term policies can be converted to permanent insurance, whether it's whole life or universal life, with no medical examinations. It's a guaranteed conversion. If you have a client with a term policy that's coming up on an expiration, we can underwrite that case. We can do the medical underwriting and then underwrite the policy as if it's converted to a permanent coverage. And if the offer is accepted, we can convert the policy directly to a whole life or permanent coverage and transact in a life settlement. So in this case, the insured has had the benefit of paying a very low premium rate for a term policy. And at the end of the term, in most cases, the policy expires and goes away with no payment. However, in this term to perm conversion, we now have a new opportunity, and so do you, to look at these term policies for the opportunity of converting them into cash for your clients. In most cases, policyholders intend on letting the terms lapse when they purchase them. So this is absolute found money in these scenarios. The LifeLine program has completed thousands of transactions since 1989. And each one, the situations are always a little bit different. I'd like to go through a few case studies with you at this time to show you some examples of actual transactions that the LifeLine program has completed. This is an 80-year-old man with a universal life policy, had it issued in 2008. It was a $2 million policy, zero cash surrender value, which means that this policy would have terminated, the insured would have got nothing. We were able to hand the insured $375,000, which was found money to the insured and to its advisor. The second case study is an insured that was 79 years old, issued the policy in 2003, $2 million face value, had a cash surrender value of this one of $250,000 and surrender value of $178,000, which isn't bad money. However, we were able to transact in a life settlement and pay that insured $515,000 for their life insurance policy. But a 73-year-old man had converted the term to perm conversion that we were talking to a little bit a few slides ago. Here's an insured that had a $3 million term policy that had no idea that there was an option to sell that policy. We were able to convert those $3 million term policies, actually had three $3 million term policies, to a settlement of $1.4 million. That was certainly a happy insured and a happy agent and financial advisor that was connected to that case. Some general pricing guidelines that the LifeLine program utilizes. Age of an insured, usually 70 plus, that fit into our parameter. Now, there are exceptions to those cases. If an individual has a terminal illness or the health is failing and their life expectancy has been abbreviated, we would recommend you contacting the LifeLine program to get a free appraisal of that individual case. The life expectancies are 2 years to 180 months. All these are based on verifiable clinical diagnoses. Policy size, $250 million to $10 million. However, anything below $250 or above $10 million will be reviewed on a case-by-case basis. The policies that we enjoy looking at are individual, survivorship, convertible, term, whole life, group. However, the group must be within the conversion period and would have to be converted prior to transacting with the life settlement. All life settlements considered by the LifeLine program must have an A or better rating from AM Best.
This is Scott Sanders again. And on page 28, although I don't want to read each one of these to you directly, and I think a lot of these are probably self-evident to you. But again, what we've found is we've expanded our outreach into the RIA community and the family office and the wealth manager community. What we found, again, is less an understanding once we describe what a life settlement is of what the benefits to the wealth advisor are, because they're rather self-evident, but again, one of awareness and an understanding of what the opportunity is for the wealth advisor to really deliver new value to his or her clients that they typically were unaware that they could deliver before. So, some of the obvious ones are if you're able to completely fulfill your, in some cases, the fiduciary responsibility. Many cases we like to describe, add another arrow to your quiver. It's an opportunity to talk about products and solutions and services that haven't necessarily been something you've been able to fully refer to or speak intelligently to before, and strengthen the relationship with your clients, and then really the obvious one, which is ultimately increase your AUM. We know that in a world and an environment in which you're fighting for assets to manage with your clients, especially in those fee-based relationships, the opportunity to, in a case of a policy that's no longer needed, to reduce the negative cash flow drag out of your AUM, and ultimately see a significant uptick by virtue of the sale of that policy, in many cases is very appealing to the wealth managers that we've spoken to. Scott, I'll hand it back to you for the final pieces here.
I think this would be a good time for us to take a poll from the audience. If everyone could take a moment and please complete the poll. And the question is, have you ever requested a policy review on an insurance policy in your ILIT? And the results. Push these results. So it's interesting. Almost 77% of our audience have never requested a review of an ILIT. I think perhaps this webinar is coming at a good time. Again, we believe anyone that has an ILIT should be reviewing the life insurance policy, the content of that ILIT, to make sure that it is performing as it should be. The LifeLine program could help you with that information. Feel free to contact us directly at 1-800-252-5282, or you can check us out at the web at www.thelifeline.com. Now to continue for a policy review, since we found that almost 77% have not done this yet, some of the questions you may want to ask is to your client and to the trust, to the beneficiaries and the insured, is the coverage sufficient? Is it performing? Is it guaranteed to older ages? And will the premiums go up? And also consider a potential life settlement, the sale of that policy. If the insured no longer needs or wants that coverage, or it's outdated, in many cases the trustees, or the ones receiving the crummy notices, are watching the assets under management dwindle by paying these premium payments. For financial planners and financial advisors, you're watching the assets under management dwindle, which is taken away from your fees each year when a life insurance premium payment is made. So we'd like for everyone to consider a life settlement as an opportunity to provide a great service and make appropriate consultation to your client, and also help the financial advisor to create more assets under management. If what you've heard today you think life settlements can be part of your financial planning package, please feel free to contact us. Again, you can reach us at 1-800-252-5282, or you can check us out on the web. I'd like to move the section now to questions and answers.
Well, Scott, very informative and impeccable timing. We're almost at the top of the hour, but we do have some questions, so I'd like to get right to them. The first one is a little lengthy, but let me jump right in here. It's an observation. It has been my experience as a licensed attorney and insurance agent that life settlement is often pursued as a new commission-driven commodity without being accompanied by a thorough and thoughtful advisory process. If the life settlement option is turned down, the agent does not get compensated. I see this as an accelerating issue.
This is Scott Sanders. It's actually a great question, or I guess in this case, great observation.
Indeed.
We have to take the position that the more information that the seller has, the better. So the more comprehensive a review that the advisor, and whether that advisor is an attorney, an accountant, a life insurance agent, or a wealth advisor, the better. We think ultimately it's not a simple transaction. It's a complicated transaction with tax implications and all kinds of other things attached to it. So we think that ultimately the more information that the seller can get from his or her advisors, the better. So we certainly don't recommend that a life settlement be taken without a comprehensive review and a comprehensive review of the financial implications and a real understanding of insurability and all of those other accompanying issues. That's a very good question, though.
Super. And as you said, a great observation. Next question. What face amounts and ages typically make the most sense to sell, assuming the insured is relatively healthy?
I'm going to give, of course, the answer is it depends. It depends on how old the policy is. Typically, older policies price better. But if the base assumption is that the seller is a healthy individual with minimal to no impairments, I think we will see kind of mid-70s to early 80s is typically where we'll buy. The size, as we've described in the document, between $250,000 and $10 million in face. We haven't really bought any smaller than that, although we can. We have bought larger than that. But typically, if the seller is very healthy, we do see a lot of that. We do buy, and in many cases, we prefer the policies of healthy individuals. While we do, again, buy policies of insureds who are otherwise impaired, we do buy a lot. So, for example, in what we own today, the average age of what we own is about 81 years old. Policy size, again, ranges anywhere from $250,000 to $10 or $11 million.
Great. Susan, I had a little computer hitch. Would you ask the next question while I try to log back on, please?
Certainly, Mr. Santos. Scott, the next question here is, what's a typical payout for a life settlement?
Typical, tough. Again, typical is tough, but as Scott said, the easiest assumption is that it's going to be a multiple of the surrender value. And so, whether ultimately we're paying, as Scott said, up to 60% of what the insured has paid in premiums up to that point, or call it 15 to 20 to 25% of the face value, it just really depends. But it's universally, if it makes sense, is going to be a multiple of the surrender value. It's not something that obviously makes sense for the insured to undertake.
Susan, why don't you continue, because I'm having a difficult time refreshing.
Absolutely, Rich, no problem. Before I get to the next question for our two Scotts, I do want to make one mention to the audience. I'm going to be pushing an exit survey to you. So if you have pop-up blocker technology, I ask that you please disable it so you can receive this form. Okay? Now, next question for our two Scotts. Did you really say diminishing fees for advisors as an incentive?
Can you restate the question, please? I'm sorry.
Certainly. The question is, it's regarding diminishing fees for advisors. Did you really mention those as an incentive?
Diminishing fees on, I want to make sure I understand the question. Oh, I'm sorry, for the assets under management. Yes. Our experience has been that to the extent that wealth managers are obviously trying to accumulate the largest asset base they possibly can, whatever else is going on in the environments in which they're investing their clients' assets, we know that to the extent that they can grow that from their existing client base, and in this case with a life settlement, yes, we think that is an incentive.
Okay, I think we have time for one more question. The question here, and Susan, thank you for your help. The question here is, how does the advisor make money on the life settlement? Does the advisor become the agent of record?
The answer, again, is it depends. We've worked with some large wirehouses that don't permit their advisors to take a fee. They are assets under management incented, and they're not allowed to take a fee per se directly from the settlement transaction. There are others where that is the case, but we're a full disclosure shop. Any fees that are paid to anybody else in the transaction, we're fully transparent, are ultimately communicated to the seller. But again, it's on a case-by-case basis. It depends on a number of different factors, but ultimately everything is fully disclosed to the seller.
Okay. And at the risk of running over time, there's another good question. I'm going to proceed. Can you please explain how you convert a level term premium policy to a life settlement policy? Mind you, there is no cash value in the term policy?
Yeah, that is a good question. The way we convert term policies to permanent coverage policies, be it a whole life or universal, almost all term policies have a conversion privilege. And what we do is take advantage of that term conversion privilege. There's no out-of-pocket cost to the insured. If an advisor can get to the term policy and get it to the LifeLine program for evaluation prior to the expiration of the term, we will underwrite it as if it is a permanent whole life or universal life policy, and we will handle the conversion and pay the conversion premium through the LifeLine program, and then purchase the policy and pay the insured the settlement value.
Great. Well, both of my Scotts, we're out of time right now, but I'd like to thank you both, William Scott Page and Scott Sanders, for their informative presentation this afternoon. And I would like to thank our sponsor, the LifeLine program, for making this event possible. And I'd also like to thank our audience for your time, attendance this afternoon, and for the great questions. We hope you found today's event valuable and will return for future webinars. So with that, I wish you a great remainder of the day. Bye for now.